The ETFs on this list do not pay quarterly dividends, rather they do so every month. I chose 6 of the best, in my opinion, that will pay you the highest dividends and give you the most bang for your buck. Welcome to Financial Fluence. In this video, I'll show you the top 6 monthly dividend ETFs to earn income in 2022. Let's now get going. Number 6, DHS or Wisdom Tree US High Dividend Index. It seeks to track the investment results of high dividend yielding companies in the US stock market, so you don't have to waste time researching and attempting to find the highest dividend paying stocks, because this ETF already does that for you. And by purchasing shares of this ETF, you're automatically giving your portfolio targeted exposure to the highest dividend paying stocks in the US. For example, among the 315 stocks that this ETF currently owns, some of its top holdings include companies such as Pfizer, Cisco, Verizon, AT&T, and Coca-Cola. This ETF's performance is also quite strong because it owns a number of reliable businesses. DHS has given an average annual return of about 11.57% over the last 10 years. Which means that if you invested $10 in this ETF 10 years ago, your investment would have grown close to $30,000, on top of the 3.77% dividend yield that this ETF offers. Now, for an ETF that pays such a high dividend, and it's not even the highest on this list, it's quite remarkable to see how much it's grown in the last decade. DHS gets a 3 on a scale of 1 to 5. In terms of expense ratio, it's not the cheapest or most expensive ETF in the world. With a 0.3% expense ratio, you can expect to pay $38 per year on $10,000 invested. Number 5, SPHD, or Invesco S&P 500 High Dividend Low Volatility ETF. It is based on the S&P 500 Low Volatility High Dividend Index, which tracks the performance of the S&P 500's 50 least volatile high dividend yielding stocks. Because SPHD was built around the index, it's safe to say that it's a great choice for your dividend portfolio. SPHD currently owns 51 stocks, with top holdings in Iron Mountain, Altria Group, and other potentially unfamiliar companies. We can't look at the ETF's 10-year performance because it was founded in 2012. However, since its inception, this ETF has had a yearly return of about 11.03%, which means that $10,000 invested in 2012 would be worth slightly more than $23,000 today. This ETF will pay you a monthly dividend of 3.86. It rates as a 3 on the risk scale. The expense ratio is 0.3%, which means you'll be paying $30 per month. Number 4, PGX Invesco Preferred ETF. PGX only invests in preferred stock. Preferred stock is a special type of stock that pays a set scheduled dividend similar to bonds. But they differ from bonds in that by owning shares of preferred stock, you still have ownership of the company, whereas bonds do not. Preferred stock is also known for paying out higher dividend yields. PGX currently owns 301 preferred share issues, including Citigroup, JP Morgan Chase, and others. Over the last 10 years, PGX has returned about 6.73% per year, which means that $10,000 invested 10 years ago would be close to $19,000 today, with a dividend yield of about 4.87%. PGX has a slightly higher expense ratio, coming in at 0.52%, which means you'll pay $52 per year on $10,000 invested. And because this ETF only invests in preferred shares of stock, it carries slightly less risk and thus ranks 3rd on the risk scale. And before we continue, don't forget to subscribe to the channel, hit the like button, and turn on the notification bell to be notified every time a new video is uploaded. Let's return to the video now. Number 3, DIV or GlobalX Superdividend US ETF. Very similar to number 5, the only difference is that DIV invests in low volatility and high dividend paying stocks across the entire US stock market, instead of only investing in the S&P 500. DIV owns 50 of the top dividend paying stocks in the United States. Because this ETF was established in 2013, we are unable to track its 10-year performance. This ETF's growth is slower than the others on this list, but it makes up for it with the highest dividend yield on the list, with 5.8%, and it has provided an average annual return of about 4.67 since its inception in 2013. So far, so good. But it's also on the verge of having a high expense ratio, with a 0.45% yield, which means you'll pay $45 per year on $10,000 invested. DIV is a 5 because it is riskier than the other ETFs on this list due to its limited investment in 50 companies, low returns, and higher expense ratio. Number 2, SDIV, or the GlobalX Superdividend ETF. This ETF, however, differs slightly from DIV in that it invests in 100 of the world's highest dividend-paying stocks. The ETF currently holds 104 stocks, with top holdings including China Power International, Yanzhou Coal Mining, and a few other names. In other words, while your hypothetical $10,000 investment is not losing value, it's not growing as much as if you invested in, say, a growth ETF or something similar. However, as I've mentioned numerous times in the video so far, typically what you lose is what you gain. This ETF has only returned about 3.1% per year on average. Less capital appreciation of that ETF or stock will result from receiving more dividends. But since you're investing for income anyway, that should be fine as long as the ETF or stock isn't steadily losing value. For instance, it would be a problem if you invested $10,000 in an ETF and 10 years later, your $10,000 was only worth $5,000. SDIV currently has a dividend yield of 6.83. If you're an income investor, you should be fine with that, as long as it's either staying largely flat or increasing slightly, and you're still receiving those high dividend payments. Because this stock invests heavily in foreign stocks, which frequently have higher volatility than American stocks, it is 5 on risk. This exchange-traded fund has a high expense ratio of 0.59, which means that a $10,000 investment will cost you $59 per year. Number 1, KBWD, or Invesco KBW High Dividend Yield Financial ETF. It is based on the KBW Nasdaq Financial Sector Dividend Yield Index, which consists of U.S. financial companies that are usually engaged in business providing financial products or services, such as banking, insurance, or loans. The current 10-year average is around 8.75% per year, so $10,000 invested 10 years ago would have grown to $19,700. However, the reason this ETF is ranked first is because of its extremely high dividend yield, which is currently 7.37%, and that comes with a higher expense ratio of 1.24%. It is a 5 on the risk scale because it only invests in 41 companies, all of which are financial companies, whose performance is affected by changes in the US interest rate environment. Now, what is dividend yield? The first thing you should know is that dividends are paid out per share. So, if a stock pays a 2 dividend and you own 10 shares, you'll receive 20 in dividends per year. There's a very simple formula to calculate the exact amount. It is dividend yield divided by 100 multiplied by the current price of the ETF. For example, dividend yield of 7.37%, divide that by 100, multiply the result by the ETF's current price. In this case, KBWD is at $20.41. Then you'll earn about $1.50 in dividends per year per share on the ETF that you own now. This may not appear to be a lot of money if you only own one share of this ETF, but the idea is to own as many shares of a dividend ETF, or dividend stock, as possible. So, if you own 1,000 shares of KBWD, your annual dividend payment would be $1,500. To increase the amount of dividends you receive, simply purchase more dividend stock or dividend ETF shares. This is how people live off of dividends. And that's all. I hope you enjoyed this video. If you enjoy similar stuff, check out my other videos. And if you like it, hit the like button, subscribe to the channel, and turn on the notification bell. And I'll see you in the next video.